Good morning, everyone. Thank you for joining us today. This is Nami from CoinPost Japan, and I will be the moderator for this panel. We are here to discuss a timely and important topic, flight to stability, repricing global risk. Before we dive into the discussion, let's quickly hear from our speakers. Would you please give us a brief introduction of yourself, your name, your role, and your currently focus?
Sure.
Let's start with Ciara, please.
Hi, I'm Ciara San, founder and managing partner of C-Square Ventures. We are an investment vehicle in Web3. We invest in both early stage deals and also we have a liquid fund as well. Prior to fund C-Square Ventures, I lead investment, listing, and institutional business in global markets for Huobi. I'm very glad to be here.
Thank you. Kelvin, please.
Yeah, sure. Hi, I'm Kelvin co-founder and CIO at Spartan Group. At Spartan, we do two things. We invest and we advise. So on the investment side, which is the part that I manage, we have 2 venture funds and 2 liquid funds. And on the advisory side, we basically help companies in the crypto space to raise capital, do M&A, as well as restructuring, and also OTC trading. And then prior to Spartan, I was with Goldman for 18 years, running Goldman's investment research team in Asia. And subsequent to Goldman, also spent about 2.5 years working with a New York-based equity long-short fund before finding my way into crypto.
Thank you. Bryan, please.
I'm Bryan. I'm an investment manager at Foresight Ventures. We're a research-driven fund that has 400 million under management, and then we just launched a 50 million fund that specifically look at RWA and also payments last year, and that's around 50 million-ish. And then what I do is I mainly look at all tokenization payments or AI payments as well, and sometimes DeFi.
Thank you so much. All right, let's dive into the discussion. We see in 2026, the world feels pretty tense, right? Geopolitical conflicts are heating up, and everyone is watching that oil choke point, Strait of Hormuz. And on top of that, economic policies and regulation moves are shifting at a fast speed. All these factors are making both traditional and markets and crypto repricing risk in a real time. So my first question is that, as crypto assets have become deeply integrated into TradeFi, from the whole picture, what do you see as the biggest risks that currently affecting the global asset allocation? Ciara, would you start, please?
Sure. So I think first and the most important is liquidity tightens. For crypto assets, the liquidity doesn't really moves up when traditional assets liquidity tightens, and in fact, it amplifies. So I think that's one of the biggest challenging factors that we're facing right now. And also the correlation between crypto assets and all of the other traditional assets are getting bigger and bigger over the years. So is making traders having bigger challenges when they trade, and also in downturn, if correlation is much higher, then diversification doesn't really make sense. Also during liquidity downturn, cross markets, across different exchanges, and right now if we see trading between traditional assets, securities, bonds, and crypto assets is definitely getting harder, because compared to traditional assets, one of the differentiator is that crypto trades 24/7. So we're facing that liquidity challenge, all the time.
Yeah, I think from my standpoint, there are a couple of things that we are spending more time on. I think the first is the fact that markets are very macro-driven currently, right? So whether it's tariffs or it's geopolitical tensions, those have been whipsawing market on a week-to-week, month-to-month basis. And obviously because of that, there's a lot of correlation between the different asset classes. For crypto, Specifically, I think we're sort of in a phase where we're coming off of the last cycle highs. And so some of the excesses from the previous cycle is still getting played out in the public markets. So overall activity level, I would say, is quite muted, both in terms of venture side as well as in terms of public market exposure. I think what's really interesting, which is the second trend, is that from a regulatory perspective, we're obviously seeing progress, right? Particularly in the US, where we've had the Stablecoin Act launching last year, and we're sort of going back and forth trying to get the Clarity Act, passed through. I think the regulatory developments are obviously very positive and important, and long-term will bring institutional investors into the space. I was at the Digital Asset Summit in New York a few weeks ago, and there was definitely a lot of interest from the larger institutional investors, right? So that's a very positive long-term picture. But then conversely, when you look at what's going on within crypto today, where the market is still very much retail-driven, the sentiment is actually very negative, right? So long-term picture bullish, short-term there's a lot of bearishness in the market at the moment. So I think we have to go through this phase where some of these excesses get digested and the regulations get passed, to bring us to better market conditions down the road.
Thank you.
For me, I think. Well, welcome.
Hi.
They want us to swap here.
Sure, no problem.
Thanks. Hey guys.
So let's welcome Akshat. Hi. So would you give us a brief introduction of yourself? Your name, your role, and your current focus.
Yeah. Hey guys. My name is Akshat. I'm head of Maelstrom, which is the family office of Arthur Hayes. Sorry, I didn't mean to interrupt the conversation here.
Yeah. So we are talking about the current factor that interact with TradeFi and DeFi, and we're talking, Bryan, would you add a little bit on that?
So I think the risk is TradeFi got in thinking about diversification that might not work anymore. I think the more systematic risk that everybody's not seeing is because TradeFi and DeFi is actually getting more connected, there's a flywheel for both. And the problem that leads to is dollarization, right? And that's quite systematic. So the good thing is when TradeFi launching ETFs or direct allocation, crypto grows. And then when people rush into crypto, you see them start buying tokenized stocks, equities, bonds. So that grows as well. But every one of this is settled in dollars, and that might be a problem because if you look at what, for example, the Bank of International, their settlements are saying, it's called digital dollarization. This is quite bad for local, obviously emerging markets. You see Filipino workers receiving in stablecoins instead of pesos, SCA merchants settling in USDC, or LATAM workers saving in US treasuries instead of local bonds. So I think all these, especially for these global asset allocators, for ones who are actually investing in emerging markets, now you have a new risk that you have to price in, right? You have the weaker local currencies, you have a weaker monetary policy as well. It might not work, and then that further affects the local economy. So I think that's the risk that we have to look at as well.
Thank you. So Akshat, would you add on more opinions on that?
Yeah. Can you repeat the question again?
So what are the biggest risks that currently affecting global asset allocation?
Yeah, I heard some of the answers. I think you guys hit macro pretty hard. Within crypto, I would agree with the sentiment that obviously retail has been left out in the past year or so, as the Trump administration came into power a year and a half ago, and there was a lot of kind of New York, DC, Silicon Valley nexus shift in sentiment, whereby Wall Street started coming into the crypto space, and now you got regulations coming through nationally, Clarity Act, Genius Act, and so forth, which is expanding the size of the pie, but the addressable market for retail has gotten smaller, and I see that as a temporary thing. I don't think that's going to last, because the frontier of innovation is always where retail gets to participate, and that's always going to be one step too far for Wall Street. Wall Street's always going to be following. So I think in the next innovation cycle, crypto happens in cycles in terms of prices, but it also happens in cycles in terms of innovation. And in the next explosion of innovation will expand the frontier. The frontier will be settled by the retail guys, and then the retail guys will bring along Wall Street a couple of years later.
Thank you. Thank you all. That gives us a good macro overview. So let's zoom into crypto industry itself. Well, just a few days ago, on April 18th, capital got hacked, and we saw that Arvis TVL dropped nearly $10 billion. Suddenly, everyone was rushing out to pull their money. It's basically turned into a DeFi-style bank run. And at the same time, AI is making attacks faster and smarter, and quantum computing might be a long-term threat to blockchain security. It seems that we are facing a lot of challenges from all the different angles. So what do you think are the most urgent risks to crypto right now?
I think, first of all, composability. Crypto is very exposed. So when incidents like this happens, it's over 100K Ethereum, it quickly moved to other assets, and it's making DeFi markets really hard to survive. And also, we talk about liquidity. It's still very fragile in crypto assets. It's fast to move around your assets. It's fast to move around liquidity in crypto, but it builds slower than it moves away when incidents like this happens.
Yeah, my perspective is definitely there have been a couple of high-profile hacks this year, right? And the KeltDAO hack as well as the Drift hack were probably the most meaningful ones so far. Yes, I think Aave's TVL got hit, but I wouldn't necessarily call it a bank run, because typically in a bank run, everyone's panicking, everyone's trying to get the capital out, and then the bank has to, restrict that, right? So we didn't see any panic when you saw it, right? Obviously, people who had too much assets on Aave decided to de-risk, and it happened very orderly. So I don't think there's a crisis or panic or anything like that. I think with respect to the AI developments, I think that's interesting in the sense that obviously AI is becoming more capable every day, and I think long term that's a good thing because it means that we'll be able to use AI to basically go through all of the smart contract code that's out there and identify these vulnerabilities and hopefully fix them. Short term, obviously that's going to be a controlled process because if various people get hold of that kind of capability, it could create disruptions in the market short term, right? So I kind of applaud or commend Anthropic for sort of raising the issue and then sort of making sure that the process is being rolled out in a way that's very systematic. Interestingly, for both the KeltDAO as well as the Drift hack, it wasn't AI, right? That was the problem. It was North Korea, right? And it was social engineering, right? So it is vulnerability in the way that these organizations are set up and how they sort of conduct their OPSEC. So, these are problems that have existed for many, many years. It's nothing new. Yeah.
Thank you.
Yeah, I'd echo the same sentiment or similar sentiment that this was fundamentally, it was user error. There was some pretty poor practices as far as multi-sig management, too many single points of failure, which I think implies two things. That one, some of the teams that we as VCs and we as retail, as an industry back, we need to hold them to a higher standard. And as our industry scales, the time for amateur hour has passed. There's more dollars at stake. It matters more now. But secondarily, also, we need probably to rejig systems such that there are fewer single points of failure in the first place. So it's not only mitigating human error, but it's also just mitigating the possibility of human error. So that's a category that we're going to focus a little bit more on in our DD. Luckily, none of our portcos have had similar experiences yet, but that's stuff happens, and going forward, we're going to make sure that we look at protocols and companies, startups, et cetera, that are focused on that as well.
Thank you.
I'll go. I also agree it's not a bank run. It's just users should have known the risk with unified pools. That's what it is. It's just users who didn't thought through clearly or who realized they couldn't take the risk decide to leave. So that's just a design choice of lending protocols. And on practices, I agree. It's just very poor practices. I think teams should probably focus a little bit more on operational disciplines instead of just, it's not just like I do a smart contract audit and I'm done. It's more like the whole setup, and then especially the ones with the keys being more aware of social engineering, things like that. And outside of that, I think probably the biggest security risk out now is it's probably from AI agents. Like for crypto users in general, like to explore tech. That's probably how they got into crypto, and they're playing with AI agents. And they use their wallets, they run strategies, they buy stuff, they like A2A commerce. And it's very easy to, the tech surface is a complete new one. Like it's about context and memory now. Like the agent it can be contaminated on the memory part and then just run. They think it's running what it's supposed to do. And money can be exploited without even the hacker touching smart contract or any kind of code at all. So I think that's also a new surface that we should be aware of or to invest in, because like it's all wallet controls and stuff, right?
Thank you so much. So may I ask, how do you actually judge whether a project or a protocol has a resilience? So, Ciara.
Sure. I think it's very important to be able to pivot because this market moves so quickly and narrative always changes. For a team to be able to raise a good amount of money during bear market, I think they have a good chance to survive, but they have to be able to pivot fast and be very flexible and listen to advisors, like our panelists right here. I think giving that investors and advisors can have multiple cycles experiences. So I think that's very important for them. And don't panic and ask for help and work with the institutions and users and be very transparent, especially during incidents like what happened to Kelvin. I think it's very important to remain good communication and transparency, and we're all in this together to work with the community. Yeah.
Thank you, Ciara.
Yeah, I think for me, in terms of identifying founders that have resilience, I think the most important thing, apart from sort of their track record, right? I mean, to the extent that they've had previous startups or ventures that they have done before and have had success out of that, I think that's a good sign. I think the other thing is just the personality of the founders themselves. We actually invested in a few projects where some of the founders were struggling, right? I mean, they had raised capital, they had built what they intended to build, but then either the product didn't get traction or the users weren't quite there yet, and so they had to explore pivots. Some of them tried raising money, but obviously in a market that is slow, fundraising isn't the easiest. And then they basically came back to the original LPs and said, hey, can you give us additional capital, right? As sort of a way to quickly raise money, and we said no. Right, we said no, and we wanted to test the founders to see what they would do in that circumstance, right? Most of the weaker founders would basically just close shop and say, okay, we're giving up, right? But we had a couple of founders that basically said, okay, that's fine, we will continue to fund this, we will cut costs, cut our team to the bare minimum, we will continue to fund this, the founders will go with no salary, and then guess what? Because they were under so much pressure, they kind of innovated, right? They really sort of figured out how to solve the problem, and then they pivoted and became very successful.
Yeah, thank you.
Yeah, I think founder quality definitely is probably one of the biggest signifiers of success in our view. Obviously, you have your checklist as an investor, right? You want to look at total addressable market. Is it big enough to go after? You look at some of the technical components of the product itself. All that matters, but it can only go so far if you have a founder who is willing to take it that far. And that usually depends on their own ability to remain stoic in different market conditions, for example. Their ability to keep shipping, building, be empathetic, responsive to the needs of their clients, customers, end users, whatever. Their ability to communicate the story to new types of users as we climb up the value chain, touching Wall Street, larger pools of capital, and even their ability to just survive. Sometimes that's in bear markets, right? You see a lot of protocols kind of disappear, but there's very few that do survive, and those are the ones that in the next bull market see quite a bit of success. So I would also agree that the founder quality is one of the biggest signs of resilience for a protocol.
Thank you.
Yeah, I think they probably just covered all of them. I'll just share one characteristic that I recently found from one of the founders we were talking to. So because of the Kelvin exploit, because it was a one-on-one setup on the DVN, right? And then when we asked, he replied quite quickly. And then the first thing he said was, we're working on it, we can't reply to you anymore. And then within at the end of the day, it was a full statement on did it affect them, or after it affected them, what next steps are they gonna do? It was quite quick. It was faster, even faster than the ones who got hacked. So probably obviously because those are more complicated than they were their experience, the exploit. But yeah, I think these kind of characteristics is what we're looking at.
Well, thank you for those detailed insights. So we've talked about the risks. Now let's move forward to how we are actually trying to measure and handle them. So we can see that prediction markets like Poly Market and Kalshi are pricing geopolitical events in real time with huge trading volume. At the same time, big institution tools like BlackRock's Aladdin are help large institutions better understand and manage their crypto risk. So here's my question. How are we actually pricing and managing the risks today? Ciara, would you start?
Can you clarify, like when you say how are we managing risk, what specifically are you referring to? Like
So
portfolio or what? Or
yeah, managing for portfolio, yeah.
do you guys want to go? Your Ciara break?
I can take it. Yeah, I mean, for us, we've got a pretty broad portfolio, right? So our fund we started in 2022 Q4, did our first deal in 2023, and now it's been over 3 years, and we've got some 49 positions still. Obviously, the weighting has changed dramatically as initially all the investment checks were the same, and some companies did 100x type returns, some were 50, and then a bunch were in that like 5-10 range, and then a good like third close to zero, something like that. And over time we've sold and rebalanced. Quite a bit has changed, but for us, our principle remains the same: that if we have conviction behind one project and we think it's underpriced, we'll buy it, right? Even if we are overweight. We prefer to have a slightly more concentrated portfolio rather than constantly rebalance. We have the most insight into how these protocols are doing because we get investor updates. We're also just constantly looking at them. We believe that we know better than retail on that front with our portcos. So we're able to have very high conviction bets once we're in a company. But in this current market where the standard model of get into pre-TGE round and then it gets dumped on retail going forward, as that kind of erodes and we see more of like the hyperliquid-like model, the playing field is getting more and more even. So we're not going to have that much more information than retail, maybe less, to be honest, than some guys focus on this 24/7, focus on one company. And I think that our risk model is going to have to change accordingly, and we're still trying to figure out how to adapt for the next cycle.
Yeah, I think for risk side in general, it's just with or without these, we still measure risk like very carefully. But because of that hack and stuff, we took a new angle of just we're internally evaluating how we're supposed to evaluate creators because of the risk. Like look at risk-staked assets, everything. It's so correlated. Even the protocols themselves are correlated, and our curators even actually evaluating these kind of risks. Does their risk engine cover that? And because, especially in Western or Eastern, everybody is doing tokenization as well, and there will be new group of curators coming on, and they need to care about these as well. And because we invest a lot in tokenization and RWA, so we ourselves have to learn how to do this as well. Like, I need to learn how to evaluate your team and your capabilities of managing tokenized collaterals.
I think for us, because we have both venture and liquid, so on the venture side, I would say there's not a lot of risk at the portfolio level because the risks are, in a way, offsetting. As Akshat sort of talked about, you have your winners and you have your losers, and they kind of like balance each other out. So the risk management from a venture standpoint tends to be in terms of how we size our investments, just to make sure that the lower risk bets we size bigger, the higher risk bets we size smaller, right? So in that way, you don't have too much concentration or taking too much risk at the very early stage. And then the second sort of risk management piece for us is really around, if let's say one of our projects does well and it gets listed and the token does well, but we're locked up in the initial year, how do you lock in those gains, protect those gains, right? While you're still not able to sell, right? So I'd say that's the main sort of risk management around the venture funds. On a liquid fund, obviously it's quite a bit different in the sense that we have directional funds, so we have to take a directional view on the market. We can have leverage, we do yield farming, so we do a lot of strategies out of the liquid fund. But the main risk management is number one, OPSEC, right, to make sure that we don't suffer any hacks of any sort. Number two, managing our collateral risk, because we trade perps, right? Managing our collateral risk, our funding risk, and the amount of leverage that we take on. And then just making sure that, if markets are volatile, we're not caught flat-footed in the opposite direction.
So as for our VC fund, we also try to communicate with profitable companies quite frequently, and especially work with them during exit periods. However, I think one of the bigger risks here is that a very small percentage of the tokens are actually liquid on the market. So, very unfortunately, altcoins get manipulated quite easily. What happened to Rave now? So it's very sad. And sometimes even when you work with the teams directly and you understand their strategies and their plans, they can still get manipulated by some so-called market makers or like bigger monies or bigger whales that they work as a group. And because a lot of the tokens are locked, required by exchanges or just their liquidity plans, that's one of the bigger challenges there. So what we are doing is that we're using more tools to monitor what's happening for the tokens, on chain, and to really try to see the movements of the tokens and to act very, very fast on that front. As for our liquid fund, what we can do is very limited because of the nature of the fund. We only trade Bitcoin, so there's not really a lot to work on there. But I do hope that as for our market today, especially the exchanges, to giving it more thoughts on their requirements for listings, and hopefully good teams remains during markets like this.
Oh, thank you all. I think we've covered a wide range here. So finally, if you could share just one sentence of a key takeaway with our audience in Hong Kong today, what would that be?
I'll start. So I think stability, right? So I think stability is not something to not just an asset to buy. It's more like of an infrastructure to set up or to time or steps that you have to carefully consider, and which is also why Hong Kong's digital asset and stablecoin regulations is taking a little bit steps bit by bit. So I think Hong Kong will still take the lead position down the road.
Thank you.
I'd say if I had to pick one word, was it? You said I'd say patience. As each subsequent jump in this industry gets bigger, right? As in we're touching larger pools of capital, we're touching more parts of the economy, more geographies, et cetera. Each subsequent jump takes longer and has a longer gestation cycle. So folks who are used to what was happening 10 years ago or 5 years ago in this industry where the cycles would be pretty quick and there was a lot of opportunities to make fast money, as if you want to make big money, it takes a little bit longer each time. So I'd say patience.
Thank you.
Yeah, I think my advice would be quite similar to Akshat in the sense that, I mean, if you look at what's happened over the last 2 years, right, the number of liquidations that have happened in crypto, whether it's 1010 or it's other major events, literally every other month there's a major liquidation event, right? And through these liquidation events, whether it's long liquidation, short liquidations, billions of dollars have been lost, right? And unfortunately, I think people still put on too much leverage when they're trading. And of course, the exchanges facilitate that, right? If you want to take risks, they're willing to facilitate that. In traditional assets, it's a little bit tougher to put on leverage, right? Because you either have to have a lot of collateral, or you have to, or the brokers or the exchanges limit how much leverage you can put on. In crypto, it's almost like a casino, right? So if you're not careful in terms of managing your risk, you can lose money very quickly. So don't get too greedy. And just be smart about how you manage your collateral and your leverage.
Thank you.
Yeah, I agree. The core of any financial activity is risk management. There's a saying in Chinese, 大浪淘沙. So whoever remains, it's the final winner. And advice for founders out there. Be very careful with how you manage users' assets as well as your own treasury, and keep on building.
Thank you. So it seems we are short in time for Q&A, but please feel free to connect with our speakers after the panel. So once again, big round of applause for our panelists. Thank you. Thank you. Thank you so much.